in physical gold. It will serve you well, it will retain value at worst, and it will outperform a lot of other assets at best. And if you happen to lose money in the stock market because you're in stocks, well, there's a good chance you'll be making up in gold what you lost in stocks. That's what the Russians did, by the way. I mean,
Yeah.
the Russians, we froze their assets, but the price of gold more than doubled
Yeah.
since that happened. So they've made, I think I did one calculation, they've made close to $100 billion of mark-to-market profits on their gold. Now, yeah, we froze a couple hundred billion of assets, but they made most of that back in gold. So
Global financial instability is accelerating as major power shifts reshape the foundations of the monetary system. According to James Rickards, a former advisor to the U.S. intelligence community and one of the most well-known voices on financial warfare and economic strategy, the world is quietly moving into a new era where trust in the U.S. dollar is no longer guaranteed. He explains that countries like China and Russia have been steadily increasing their gold reserves for years, preparing for a system where gold once again plays a central role in global settlement. Rickards warns that when confidence in fiat currencies begins to weaken at a global scale, the adjustment is rarely gradual. Instead, it tends to happen in sudden and dramatic repricing events, where gold rapidly reflects its true monetary value in a world searching for stability. He suggests that this transition could lead to significant volatility across financial markets, while also creating a major revaluation of hard assets like gold.
in other words, this is something that's not very well understood. It's called conditional correlation. And what I mean by that, or what the term means, is you look at a so-called diversified portfolio of stocks and you say, is there a lot of correlation here? Well, you say, well, honestly, when this sector goes up, this sector might go down a little bit. And so with your 10 sectors and 50 stocks and all that, the correlation is low. But in certain conditions, certain states of the world, the correlation can be perfect. They can all go down together very quickly because there's some triggering event. That's the condition. That's why we call it, pardon me. That's why we call it conditional correlation, because it's not correlated when you don't care, when things are pretty calm or pretty good, and it's highly correlated exactly when you don't want it to be, when you're
Right.
trying to preserve wealth and it's all going down at once. And that's why I say have some stocks, have some gold, have some silver, real estate, cash, maybe a big slug of cash, maybe as much as 30%. But
Wow.
I'll give you another real world example, Kerry, of how what I just described makes a difference in not just financially, but geopolitically. So let's go back to 2009. Russia had 600 metric tons of gold in their reserve position. In 2022 and continuing today, they have about 2,500 metric tons of gold. They've quadrupled their physical gold. Now, in 2009, I facilitated and participated in the first ever financial war game hosted by the Pentagon. We did it at the Warfare Analysis Laboratory. It's a top secret lab about halfway between Washington and Baltimore. And one of the I helped to organize the game, but then I played on the China team. I planted a friend, got a good guy, put him on the Russia team, and we cooked up a plan over dinner that, in this war game, Russia and China were going to announce that they were pooling their gold in a Swiss vault, and they had a UK bank of issue, and they were going to issue a new gold-backed form of money. But the catch was, from then on, if you wanted Russian natural resources or Chinese manufactured goods, you had to pay for it in that new money backed by
Mm.
gold. And if you wanted some of that money, you could do one of a number of things. You could deposit your own gold in the Swiss bank and they would just give you some money, or you could run a surplus and earn the money, or you could borrow it. There were different ways to get this new money, but of course the catch was you had to use it if you wanted Russian oil or Chinese manufactured goods. Well, when we introduced this, we were laughed at. There were a bunch of Harvard eggheads, and
Yeah.
I mean there were people there from the U.S. Treasury, Federal Reserve, CIA, uniform military, academia, think tanks, Brookings, you name it. They were all there, and we got laughed at. And then there's when you have a game like this, you use colors. So the red cell was China, and the blue cell was the United States, and so on. and there's a white cell. The white cell are the referees. They make calls and decide, add points and decide who won. They said that's an illegal move, and it was kind of it actually was a big auditorium type room. There were about 100 people there. It looked like the way they show war games on TV, big TV screens along the walls, and we all had computers and all this stuff. And I stood up. I said, "What do you mean?" I said, "This is a war. How can you break the rules? There are no rules. It's a war."
Yeah.
And they said, "Yeah, okay, you're right. We're going to say it's a legal move. It's just a dumb move." I said, "Well, we'll see about that." Well, 2 days later, it ended up that Russia got additional points. The U.S. lost points. So we made our point. But my point is, at that time, 2009, Russia and China each had about 600 metric tons of gold. Today, China's close to 3,000. Russia's about 2,500. I dare say China has a lot more off the books. Don't know how much, but that's very likely that they have maybe another several thousand tons off the book. But now come to February 2022, February 24th, 2022. What happens? Russia commences the special military operation in Ukraine. What's the first thing the United States does? We freeze their treasury securities. They had about $300 billion where they made the money legitimately selling oil for dollars, petrodollar accord. They trusted the United States, going back to my trust factor, bought U.S. Treasury securities. But you have to hold them with a custodian because they're all digital. And their custodian was Euroclear in Belgium, which has $47 trillion of assets. Now they're in custody. It's not a fund, if you will. They don't manage them all, but they hold them all in their registry. The U.S. froze those. So why didn't the Russian economy grind to a halt? Why didn't their trading partners turn their backs on them? Well, the answer was they had 2,500 metric tons of gold. And for that, I give credit to Elvira Nabiullina, who's the head of the Central Bank of Russia. And I say she's the only central banker in the world who actually understands her job. But she was the one who acquired all that gold. It's physical. It's in safe storage in Moscow. You can't freeze it. You can't seize it unless you want to invade Russia and start World War III.
Yep.
Correct. That's exactly right. Now, they're still fighting over the frozen treasuries. They got some cockamamie scheme to use them as collateral to raise a loan for Ukraine. And when Ukraine wins the war, they'll get reparations from Russia and pay the loan back. Except it's all good, except Ukraine's losing the war. Russia's going to win. There are not going to be reparations. The whole plan just falls down. It's an embarrassment, but that's the Europeans for you. But my point is, one of the reasons the Russian economy not only did not fall down, but prospered, outperformed the U.S. economy in the last 4 years, is because they had the gold in their reserves. Plus they continued to sell oil and natural gas for dollars, but they didn't put the dollars in Euroclear. I can guarantee that. So it has a place, and it offers diversification, and it's robust to war, seizures, power grid outages, you name it.
Conditional correlation is one of the most overlooked risks in modern finance. It describes a situation where assets that seem diversified, like stocks, bonds, and real estate, suddenly start falling together during a major crisis. In normal conditions, these investments may appear unconnected, giving investors a false sense of safety. But when a real financial shock hits, those differences often disappear, and everything moves down at the same time. This is why some analysts stress the importance of holding a small portion of physical assets such as gold and silver. Unlike paper-based investments, physical metals are not tied to banking systems, digital records, or government-controlled financial networks. They can't be frozen, deleted, or devalued in the same way during extreme events like wars, sanctions, or banking failures. At the same time, gold's rising value during periods of instability helped offset some of the losses from frozen financial assets. This shows why many investors view gold as a form of protection when traditional markets fail to behave independently.
Well, you better have some physical gold and silver, and not all in, not 50%. I know people who are. I don't recommend that. I kind of recommend 10% of your investable assets. Don't bet your house equity and don't bet your business, but anything over and above home and business are your investable assets. And we talked about diversification. Have a slice. I recommend 10%, but season to taste. In physical gold. It will serve you well, it will retain value at worst, and it will outperform a lot of other assets at best. And if you happen to lose money in the stock market because you're in stocks, well, there's a good chance you'll be making up in gold what you lost in stocks. That's what the Russians did, by the way. I mean,
Yeah.
the Russians, we froze their assets, but the price of gold more than doubled
Yeah.
since that happened. So they've made, I think I did one calculation, they've made close to $100 billion of mark-to-market profits on their gold. Now, yeah, we froze a couple hundred billion of assets, but they made most of that back in gold. So it served them well. And I think that's true of everyday investors. Don't think for one second that markets are efficient. The idea that the stock market is an efficient process, it accurately discounts future developments, it moves gradually to different levels based on incorporating new news. That's the theory. A bunch of people won Nobel Prizes for that. It's all nonsense. It's not just an opinion. It doesn't fit with the facts. The facts are that the stock market is volatile. There's something called scale invariance, which is big moves are the same as small moves. You can put them under a microscope. They look exactly the same. Markets are very slow to supposedly discount news, but when they catch up, they move violently, either up or down, depending on the news. And my expectation is that the markets have not even come close to incorporating what's actually going on. They, talk to
Okay.
Wall Street analysts. Talk to Wall Street analysts. What do they say? Well, yeah, they close the Straits of Hormuz. Price of oil is up, 50% or higher, but the war will be over in 2 to 3 weeks. Well, they've been saying the war's over in 2 to 3 weeks for 9 weeks.
Correct.
How many times can you say 2 to 3 weeks, in a row before you wake up and say, maybe it's not maybe it's like a year or longer.
Yeah.
That to me, that's a better frame, a better way to think about it, number one. Number two, as of now, Iran has won the war. Whatever's going on in the Straits of Hormuz, open or closed, tolls or no tolls, is being dictated by Iran. It is not being dictated by the United States. The United States has vessels offshore and air power and marine expeditionary units, but we're not patrolling the Straits of Hormuz. We're not the ones keeping it open. And as of tonight, it isn't open. So, and that's not in the market. Does oil go back up to 115? And there's another factor here, Carrie. Of course, the price is important, but there's the supply issue. You might not be able to get the supply at any price. And this is not a problem for the United States, by the way. The U.S. has plenty of oil, natural gas, because we just took Venezuela's oil. We'll
That's
take
right.
Guyana. We'll take Guyana while we're at it. And we control the Panama Canal. We're reopening drilling in Alaska, the Gulf of America. The United States is fine in terms of supply, but we're not immune from the price. So it's really making the case for real diversification. So, you would have some cash. Yeah, you need some cash. Have a slice of stocks, but have some gold, physical gold. Not paper gold. I mean, paper gold. GLDs. It's a ticker for a gold-backed ETF, and it tracks the price of gold. That's fine for price exposure. If you just want to have price exposure, make a short-term bet, it's fine. It's liquid. You can buy it on your Charles Schwab account or ANZ account, but it's not gold. It's a transaction, and it can easily be terminated. It can be wiped out in a variety of ways, easy to seize, etc. There's nothing like physical gold if you want real security. And then silver and real estate and alternatives. That's a robust portfolio, and you don't have to worry as much about what money is because you've kind of covered all the bases.
Jim Rickards is talking about what real diversification actually means. He says it's not enough to just hold cash and stocks. While those are important, they are still part of the financial system and can be affected during crises. Instead, he stresses adding physical assets like gold, silver, and even real estate to create a stronger and safer portfolio. Rickards also warns that markets are not as stable or efficient as many believe. Instead of moving smoothly, they often stay calm during early problems and then suddenly move very sharply when reality catches up. This is why investors can be caught off guard when crises escalate quickly. He connects this to global events, especially tensions affecting oil and supply chains. Energy prices don't just affect fuel, they impact everything because almost all goods depend on transportation. Even if people keep paying higher prices, they are forced to cut spending elsewhere, which spreads inflation through the whole economy. Finally, Rickards explains that supply disruptions take time to show their full impact. Even if shipments continue for a while, once they stop, shortages and price increases follow quickly. His main message is simple. Don't assume markets will stay stable and don't rely only on paper assets. Real physical assets give protection when the system becomes unpredictable.